concerned about this volatility in the bond market?
No, I don't think so, because like I said, our country is doing so well despite interest rates. We have interest rates that are they're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates.
Well, the president there isn't hiding where he thinks interest rates should go, but the bond market may have a very different opinion. Yields, take a look. They're back up today, erasing the drop that we saw after Scott Bessent's intervention just yesterday. And here's the bigger problem. The U.S. just crossed a sobering milestone, $40 trillion in debt. So the question now is whether Washington can keep borrowing at this pace without the bond market pushing back. And Dagan, I want to come to you for your expert analysis on all of this, because yesterday, like we just said, Scott Bessent announced the buyback. We did see some momentary relief, but the yields are climbing already. What do you make of that?
I said yesterday that desperation is the world's worst cologne, and it looked desperate because, as Larry Kudlow was talking about yesterday, and he asserts that yields are climbing because of growth, because growth is going great guns. And if that would be the case, then why would the Treasury Department need to intervene in the bond market unless there was some sort of serious plumbing
Trying to let
problem?
the economy catch up with the debt growth, maybe, but that's, yeah.
If the economy is so great, why are we running a $2 trillion deficit this year? If the economy is so great, why can't we reduce the interest that we're paying on our debt, which we're on track this year, 2 months left in the fiscal year, $1.4 trillion in interest on the debt. I will argue, as I have all year, this is a supply problem, a supply of U.S. government debt that started with the Iran conflict. And then that was what started kicking up long-term interest rates. Oh, you want to borrow more after you've screwed lenders over for the last 14 years? Again, longer-term Treasuries, including the yield paid, have lost money over the last 14 years. You were a loser in loaning money to the federal government over the long run in 14 years, including the interest that you've been paid, down like 4%, 25% gain on a broad bond fund, including the interest paid. But then you layer on additional supply from all the hyperscalers, from the big tech companies, where if Google's paying you 6%, 7%,
that's a great point.
The U.S. government, that's much more attractive. And it also forces the U.S. government to have to pay higher interest rates to compete with the hyperscalers, because the U.S. government has really no kind of magic money machine to pay back those lenders the way that a Google does. And it's just kind of a mushrooming effect. What Scott Bessent did, though, and I'm sure President Trump was just upset about longer-term interest rates going up, and I'm convinced, even though I have no knowledge of this, that he just called Bessent on the phone and said, hey, you got to do something. This is absurd.
Help, please.
You told me to not bitch about short-term rates at the Fed. Well, I'm bitching about long-term rates to you. You better get on it.
Well, on that note, I mean...
Well, I just want to add about the Fed. It actually gives Kevin Warsh cover. Because if you are removing supply on the long end, you give Kevin Warsh a little bit of room to do something with the balance sheet, which is he's wanted to begin reducing it, number one. And number two, if you're borrowing more, because now you're shifting the borrowing to the short end, if you're borrowing more, even more on the short end, how are you going to raise interest rates? Because you need to keep your short end low. You're not raising rates.
I actually was thinking that maybe it was, if what Scott Bessent did yesterday was successful, maybe it hasn't been because we see rates actually climbing, but that maybe it would make Kevin Warsh's job harder the Treasury working against the Fed, because you could argue that maybe the bond market has been helping respond to inflation, the concern about inflation, and helping Kevin Warsh from hiking rates.
Inflation's in check, though. The break-even inflation expectations for the 5-year have dropped off a cliff since.
But we got the FOMC meeting minutes, and they're concerned about the direction.
Yeah, but they're politicking.
Yeah, there's so many things. I mean, I don't know where you fall down on this, but from a free market capitalist, I don't like to see intervention in any way, shape, or form whatsoever. I owe you, you were right, because about 3 weeks ago, we were arguing about the markets not caring about the yields going up, and now we do. I said they eventually would. You've seen this in the last couple of weeks. I think Treasury Secretary tried to intervene to tamp that down, because I don't think the underlying economic situation is bad. It's getting better. But here's my problem. 40 trillion in debt. We've doubled the deficit, the debt in 10 years. We've quadrupled it in 20 years. Equal blame across both sides of the aisle, right? It's not Republicans or Democrats that did more or less. It's pretty much the same. We basically let our debt get out and start the race way ahead of us. We can't outgrow to catch up to it at this point. We have to do something about spending. But no one in politics, no one in Washington wants to. No one's slowing down.
They're not going to, so I'm not even going to speak to that right now. I just want to speak to Kevin Warsh and this idea of oil prices being transitory. They are transitory, but when does transitory not become transitory? Maybe Jerome Powell truly thought the inflation at that moment was transitory, and then it turned out not to be. The longer that this Iran, and I'm not a fan of Jerome Powell, but I'm giving him the benefit of the doubt for 1 second. The longer this Iran war goes on and the oil price stays elevated and gas prices stay elevated, and inflation is about a point over, or 1.5 over where they want it to be, it's not transitory anymore, right? It was supposed to be transitory when this was supposed to be fast. So that's the first point I want to make on the Warsh side of this. But he also, those minutes were before the last CPI, and that number was good. Now, I don't expect the next CPI number to be good, because oil's creeping up towards $90 again, and it had a big move today. The only thing I would say about what Bessent is doing is the point Dagan made when she was starting at the top, which is it didn't work. The market saw right through this. It worked for about a second, and then the market figured out what you were doing here. And the only thing that I, kind of will say is okay is that it's balance sheet neutral. It's not like he's doing QE or using a tool like that.
Yet.
He's moving the chessboard chips around.
It's like refinancing your debt, saying, I've got a high interest rate. You can change the maturity profile, but you're not paying down the balance whatsoever.
And he can't keep doing this or do it forever. So he's not going to fix the problem.
I have a lot of confidence in Scott Bessent. I feel like, you referenced Jerome Powell. I think that's apples and oranges. I think we're in a much better place with Scott Bessent at the helm. And, okay, so make this announcement, so maybe you don't want government involved, but I think interest rates need to be, if we're talking about the interest on our debt, interest rates being lower helps that. And so politicking, yes, because some people in the Fed still want to raise rates, and what the reasoning is, I don't know if it really makes sense, but they have an agenda, I believe, so they want rates higher. This, I think, helps that. All of us benefit right now to get rates a little lower. Ending the war in Iran, I think that transitory, maybe that's not the right word, but it will end. Oil prices, I believe, will come down because of a number of things, including technology and including how much we're drilling here in this country and how things are the landscape for oil globally will change post the Iran war. So I think the market's sitting, 1 or 2% off, the stock market, that is, off all-time highs. And I think, people will say, or there used to be a saying 30 years ago when I started in this industry, follow the bond market's bigger and it has better direction, and so follow the bond market. Hasn't worked out so well for the last decade and a half. So I think there's still opportunities here, but I'll agree with the president. We're on better footing if interest rates are lower in this country.
We get another CPI print before the next FOMC meeting. And so I guess going back to my thought about if Kevin Warsh is now understanding that the president and Scott Bessent are really focusing in on that long-term yield and trying to get that down, and if that has arguably, and feel free to disagree with me, but arguably been helping Kevin Warsh and the Fed, take their time in responding to concerns about inflation, because some of them are concerned, even if they're politicians. Yeah. Does that make this next CPI print all that more important? In other words, to your point about oil prices and gas, if we see that, tick up a little bit, Are they going to be motivated to hike rates?
Yeah, but we said that last print, right, a couple weeks ago. Like, everyone can't be the most important one. And I think Kevin Warsh is very savvy that he's not looking for a single print to determine. I think he's stuck on pause all year because I think inflation's balanced, like you said.
He needs a trend, and they're all. It's like this one. This one was good. He's not going to get another one to confirm good. He's going to get one that I think is going to be difficult, and then maybe something will change that doesn't hold a trend, and so it becomes difficult if you don't have a trend to make a decision because you really don't know what's happening.
Well, the inflation that we've seen is not. It's caused by a supply shock from oil. It's not true inflation caused, but it's not a monetary phenomenon.
Right.
So whatever these cranks at the Federal Reserve are talking about raising interest rates, and by the way, rates need to stay low in part because now we're borrowing even more on the short end, but we need to be able to inflate our way out of this debt load. So that means keeping rates below the rate of inflation. That way you inflate your way out of debt. That's one of the things that Biden and co. tried to do.